Sir, you are live now.
Yes.
Hello. Sir, we welcome you for today's session on gearing up for tax audit 2023 and 24. And for as faculty, we have with us CMA Ajit Shivadas. So, sir, we would like to hand over the session to you for continuing with the session, please.
Thank you, madam. Very good afternoon, one and all here. Today we would be having a discussion or a brief introduction towards that tax audit that we are going to have for this financial year 23-24, assessment year 24-25. So now we are in the verge of this tax audit. Definitely yes. Next month, the 30th, 39/2024, being the last date in order to file that audit report in prescribed from 3CA, 3CD, nor in form 3CB, 3CD. And the next month, 31st of October, being 139 one time limit within which those tax audit assessees would be required to file their respective income tax returns. So with this brief prelude, the points that we are going to discuss for the day, we would be having a discussion over the applicability of this section 44AB, the legislation we would be discussing. 44AB being the legislative section. The section in income tax gives the power to conduct that tax audit, along with the constitutionality. Whether this tax audit is constitutional, definitely yes. The Honorable Apex could have put up its constitutionality. Then about this section 44AB, who are all those assessees who would be required to do this tax audit, and interplay between this section 44AB with that of presumptive taxation regimes 44AD, 44ADA, 44AE we would be discussing. Then we would be going through certain points because definitely yes, time is a constraint. We cannot go on to all those clauses prescribed in that tax audit report. So some of those clauses very relevant for the time being, some amendments, some changes in those clauses. So some among those critical clauses we would be discussing. Then definitely yes, the penalty for non-compliance of this section 44AB. So those assessees who were required to conduct this tax audit report, if not uploaded before the same date, 30th of September, then what would be the repercussions? What would be the consequences? So these many things for the next 1.5 hours we would be discussing. So definitely yes, if you are having any queries, if you want some clarifications, all my learned participants, all my friends, definitely you can text in that text box. And at the end of session, we would be devoting the time in order to discuss those points. So with this, let me on to this session. So legislation, I was mentioning, section 44AB of Income Tax Act 1961 prescribes who and all who are required to do their books of accounts audited by an accountant mentioned in 288 AA. So who are all those entities who are required? We know business entities who are having their turnover more than 1 crore. What is the definition of turnover? We would be discussing later. For the time being, let us presume that turnover to be more than 1 crore. And in some cases, a provision has been inserted in that subsection number 1, wherein up to 10 crores, there would not be any requirement of tax audit. So what is that situation we would be discussing later. So those business entities who are having turnover up to 1 crore and up to 10 crores are not required to do their books of accounts audited. If it exceeds 1 crore and more, if it exceeds 10 crores and more, then the mandatory applicability of tax audit is there. Then for professionals, those specified professionals, 44AA, specified professional categories are there. So for those professionals, if their annual receipts is more than 50 lakh rupees, then they would be obliged to do this tax audit. Then we know 3 presumptive sections. 44AE is there, ADA is there, AD is there, which are popular. Beyond or other than these 3 presumptive sections, we do have a non-resident Indian shipping business and all, aircraft business and all. 44BB, BBB sections are there. So those presumptive category persons, 5 categories of presumptive persons are there. If they are not declaring the profit as per that minimum amount, minimum percentages, minimum profits under those relevant sections, if they are not declaring such deemed profit, we can call presumptive profit, we can call. So if they are declaring profits lesser than that of such presumptive profits as prescribed under respective sections, all those entities would also be required to do their accounts audited by the accountant. So that 5 presumptive persons who are required to do it are being mentioned in point number 3, 4, and 5. So a depth analysis of all these 5 points we would be doing later. So this is what about the section within which this tax audit is applicable, 44AB. We know all these things. I'm just brushing up all those concepts first. Now, the relevant rule being Rule 6G. So which are all the forms which are required to be submitted? Those entities who are required to do this tax audit. Rule G prescribes the form. And we know the audit report to be in 3CA or in 3CB, along with the annexure comment 3CD. So if you are a person, if the assessee is a person who is required to get their accounts audited by any other law other than income tax law, any other law meaning may it be a company who is required to get mandatorily audited under a Companies Act, maybe an LLP who is having turnover more than 40 lakhs and beyond point share capital and all, they would be required to get audited under Limited Liability Partnership Act. Or it may be a cooperative society who is required to get cooperative audit. So those types of entities whose accounts are to be audited by any other law other than Income Tax Act, then the audit report, the form in which the auditor would be required to report would be in form number 3CA. And for other than those who are required to get audited by any other law, other than companies, other than cooperative societies, other than limited liability partnerships, then instead of 3CA, the audit form, the form would be in 3CB, 3CB. So this is the point, this is the form wherein the tax auditor would be required to report if there are any findings, if there are any opinions, if there are any things that the auditor want to communicate to the income tax department, those things in their respective audit report, they would be required to make a note on. So these are the audit reports, 3CA for those who are required to get audited with some other law, company law I was mentioning, limited liability partnership I was mentioning, cooperative societies I was mentioning, and such and like the auditor would be required to upload form 3CA, and for others, for individuals, partnerships and all, then it would be in 3CB. Then along with that 3CA and 3CB, the report, that annexure that we would be required to upload is in form 3CD. So either it is 3CA 3CD or it is 3CB 3CD that has to be uploaded. So in 3CD total there are 44 clauses, 1 to 8A comprising of part A and the remaining up to 44 in part B. So point by point, there's a checklist. All these things the auditor would be required to report. So on those reporting points, definitely yes, assessee would be also required to taken care of. In order to not to get reported in that audit report, they have to maintain their books of accounts properly. They have to follow those procedures, so have to comply with income tax provisions. Otherwise, definitely yes, if it is being reported in this 3CA, 3CD, whatever it is, then the income tax department would be making note of them. And those associates who have been reported with all these issues, definitely yes, there are chances for departmental scrutiny or any other coercive procedure in order to do with that accounting or that verification process by the department. So definitely yes, it is better not to have any remarks in the auditor report, for which we have to plan in advance. We have to maintain books of accounts. We have to comply with income tax provisions. Then we can escape from all these negative reports to be reported in these forms. Then we know I was mentioning the 30th September being the last date within which we would be required to upload that tax audit report in 3CA, 3CD or in 3CB, 3CD. If we are not uploading that tax audit report on or before 30th of November, for this assessment here, it is 30th of November, 30th of September. Sorry, 30th of September, if we are not uploading it, after which definitely as we know, the income tax return has to be submitted on or before 31st of October. So some do have got an false notion that the report can be filed after, yes, can be filed after 30th of September also. For a non-filing of return within 139 one-time limit, we know 271F late fee is there. interest is there. But for non-filing of this audit report on or before this 30th of September, there is no straight away late fees, straight away system generated payments to be made with. But beware, those who have not filed those respective tax audit reports on or before the prescribed time limit, that is 30th of September 2024, this relevant year, then there is a penalty under 271B prescribing half percentage of the turnover or 1.5 lakh, whichever is higher, to be the penalty to be paid with. So supposing if our file is being taken for a scrutiny assessment 143.3 or for income escapement assessment 148, 147 proceedings, at that time, if the assessing officer finds that the audit report was not being filed or was being filed, but after the prescribed date, especially in case of income escapement assessments and all, nowadays we can see the audit report was not being submitted at the right at the time limits. Why? Because the return was not at all being filed in the prescribed time limits. So definitely yes, audit reports would not have been filed within those time limits. In all those cases, that 271B would be initiated by that income tax scrutiny officer assessing unit definitely, even though the audit report was being filed at the time of submitting 148 return. For the reason it was not being duly filed within the prescribed time limit, this 271B can be initiated. So those who want to or who are required to file this 270, what do you call 3CD, 3CB report, 3CD, 3CA report, definitely yes, they have to upload it on or before 30th of September. Otherwise, this section 271B would hit even after this due date. You have submitted voluntarily even before any notices or all. Then again, there is a chance that this 271B can be initiated. So definitely yes, why I am hinting this penalty section upfront is the report has to be submitted before the due date. Not only for this tax audit cases, if I add on for those trust who are enjoying those exemptions from section 11 to 13, for those trust also, definitely yes, they have to submit that audit report in 10B, 10BB on or before 30th of September. For this tax audit assessees who are not trust, only replication is this 271B. But in case of trust, if they are not uploading that audit report on or before 30th of September 10B or 10BB, they would be losing that exemption. 11 to 13 exemptions they cannot claim for the relevant assessment year. So that point is there. So definitely yes, you have to keep complying with all these time limits, especially this tax audit time limits, trust audit time limits, before which if you are not filing, you would be losing those exemptions. You would be hitting with this penal section under 271B. Then due dates I was mentioning. So those assessees who are not having international transactions, who are not non-tax audit assessees, then who are companies, as well as those persons who are required to do this tax audit. The due date for filing income tax return for this assessment year 24-25, 31st of October 2024. The due date for uploading this audit report 30th of September 2024. Regarding this uploading of audit report also, practically if you see, the auditor would be uploading that 3CA, 3CD or 3CB, 3CD. It would be reflecting in the assessee's income tax web portal. So that uploaded report has to be approved by the assessee. So that approval also have to be taken place within this 30th of September. If it has been uploaded by the auditor, but not been approved by this tax audit assessee, then also it would not be treated to be as tax audit report file. So that approval also has to be done on or before this 30th of September. Otherwise 271B would hit. Then for returns, we know this 31st October, after which they can go up to 31st of December. Belated return they can file under section 139(4). Late fee would be there, interest would be there. But this penalty under 271B would not be hitting if you are delaying submitting of income tax return. But for sure, you have to upload audit report first. And if you are uploading the audit report after the due date 30th of September, then penalty under 271B would hit. But for returns delay submission, that section would not hit if it is alone and your report was being submitted before that 30th of September. Then an exemption for this due date 31st of October. We know for those who are having international transactions who would be required to submit that 92E audit report. Then instead of 31st October, the due date would be 30th of November. Income tax return sufficient due date 30th of November. So these are all various due dates which are being applicable for those who are going to have this tax audit as well as company assessees. Then section 44AB, the legislation we are going to discuss. So first phase we have discussed the due dates, the basic section, constitutionality and all, penalty and all, penal provisions we had. Now we are going to discuss that section 44AB and we are going to discuss those correlation, those interplay between this section 44AB with 44AD, presumptive taxation for business persons, 44ADA, specified professionals, as well as 44AE, flying, leasing, hiring of goods carriage vehicle. So those persons who are dealing with 44AD, ADA, AE, whether they can go for those options. After opting the same, if they are opting out from those schemes, how it would be impacted in this 44AB, all these things we are going to discuss. So all those clauses are being respectively in third, fourth and fifth clauses. And now for the time being, the first two clauses. So I was mentioning those business entities who are having an annual sales or annual turnover, gross receipts exceeding 1 crore are required to do their books of accounts audited by an accountant. So what does the term turnover mean? Whether it is inclusive of GST, whether it is inclusive of those capital asset sales, whether it is inclusive of, say, in share markets and all, you may see futures are being sold, options are being sold. Whether the total amount of futures sold, options sold would constitute under this term turnover. So all those things definitely, yes, you would be required to have an due diligence account. Basically, this term turnover is not inclusive of GSTs, indirect taxes, whatever it is. Say 95 lakh being my turnover plus 18% GST. Therein, the total turnover, if you include that GST, it would be more than 1 crore. So whether to include that GST along with the turnover, the answer is no. Then comes, I was mentioning, with regarding to those sale of capital assets, whether it is business turnover, it is not. Sale of capital asset is a turnover or supply as far as GST is concerned. For having that GSTR form 9 applicability, 9C applicability for computing that 2 crore, 5 crore and all, sale of capital assets also we would be required to taken care. Why? Because sale of capital goods also would tantamount to this what do you call GST turnover, but not in the case here. Then comes the applicability of sale of securities, sale of this futures, options, etc. In such cases, we know only the marginal amount. It is not the selling price. It is not the purchase price. Rather, the margin between selling and purchase. Modulus we have to take. So it may be a negative loss. It may be a profit positive figure. Both modulus you have to add, and that would form part of the turnover. So in that manner, the term turnover we would be required to have a view over, and that turnover, if it exceeds 1 crore, then only this tax audit is applicable. So whether only this 1 crore limit is applicable, no, it is not. Along with that 1 crore, we may see that 10 crore also under the proviso to the section 44AB, those persons, those entities, those assessees who are having 95% or more of total receipts, as well as 95% or more of total expenses, being in non-cash modes. So which are those non-cash modes? Account payee grocery check, RTGS, NEFT, IMPVS, etc. If we are paying 95% and more of your expenses via these non-cash modes, if you are receiving 95% or more of your receipts via these non-cash modes, then you need not get your books of accounts audited under section 44 AB. So that 10 crore limit is also there. So this enhanced limit of 10 crores would be applicable only when your total receipts and total payments 95% and above should be in non-cash mode, or in other words, less than 5% of the receipts and less than 5% of your payment should be in cash modes. If so, up to 10 crore, there is no mandatory requirement to get your books of accounts audited, even though your total turnover is more than 1 crore. So in an example case, the same thing I discussed at the time of discussing the turnover, sale of securities, options, futures. So if the turnover, even though the margin amount we have to take, I was mentioning, if that margin amount is more than 1 crore, say it is 6 crore rupees, the total option turnover, future turnover, whether we would be required to do tax audit, answer is no. For the same thing I was mentioning. Why? Because in a stock market, if you are trading through a depository participant or your commodity dealer, broker, whoever it is, all those transactions, 100% of all those transactions, may it be sale, purchase, commission paid, brokerage paid, whatever it is, STT paid, whatever it is, entire transactions, receipts as well as payments are being made through non-cash modes only. Thereby, that condition, 95% condition, is being satisfied. Thereby, if you are dealing with these futures, options and all up to 10 crore rupees, there is no requirement to get your books of accounts audited by the accountant as prescribed. So this is what the relevance with regarding to this 10 crore extended turnover limit. Earlier it was 5 crores, now it has been extended to 10 crores for the last 2 years. So this is what the first clause is, 44AB A clause. Business entities who are having turnover more than 1 crore or 10 crore, the exemption I was mentioning. Then comes the professionals. If they are professionals, total receipt is more than 50 lakhs, then they cannot go for presumptive options. They cannot opt for 44 ADA, nothing. They would be required to maintain books of accounts under 44 AA, right along with rule number 6F. Plus, they would be required to get books of accounts audited by an auditor under section 44 AB also. So those professionals whose turnover is more than, receipts are more than 50 lakhs, second person. Then third, fourth and fifth I was mentioning various presumptive sections. 44 AE dealing with those who are having flying, leasing, hiring of carriage goods business. Total number of vehicles in any part of the year was more than 10. It can be lightweight goods vehicle having tonnage capacity less than 12, or maybe heavy goods vehicle having tonnage capacity more than 12. They can opt for a presumptive option under section 44 AE, wherein for light goods vehicle they can offer 7,500 per month per vehicle to be income. For heavy goods vehicle they can offer per ton 1,000 rupees per month per vehicle. So if they are not declaring the profit which was been prescribed there, then they have to maintain books of accounts under 44A, and their books of accounts have to be audited by an accountant. Just as if in case of 44 BB as well as triple B, aircraft and this non-resident shipping business and all, prescribed rates are being there. And if you are having a profit lesser than that limit, if you are not declaring that amount as a presumptive profit, deemed profit, then your books of accounts would be required to be audited by the accountant. 44 ADA along with 44 AD. We know 44 ADA to be presumptive taxation option for specified professionals. So if you are a specified professionals, then you can declare 50% of your turnover receipt minimum to be your income. In such cases, if you are not declaring that 50% to be your profit, even though your turnover is not more than 50 lakhs, if your turnover is more than 50 lakhs, definitely yes, 40 for AB, B close, it would be applicable. But if you are yourself to be a medical practitioner, doctor, and you are having an annual receipts of 40 lakhs, say example, and you would be required to minimum declare a profit of 20 lakh, 40 lakhs, 50%, 20 lakh you would be required to offer. And if you are not offering 20 lakhs, say you are offering 12 lakhs only to be your annual profit, then definitely yes, you would be required to audit under section 44 AB, clause number C, for the reason you are declaring profit. D, for the reason you are declaring profit lesser than that of the limits prescribed under 44 ADA. Just as if in case of 44 AD, you know 44 AD to be the presumptive taxation scheme wherein yourself to be a business person who is having turnover less than the prescribed limit. 2 crore and 3 crore is there. 2 crore for those normal entities, 3 crores for those persons who are having same point mentioned earlier, same criteria, 95% and above receipts as well as payment should be in non-cash mode. So if your total non-cash mode sort of a thing is up to this 95% and above, then you need not keep books of accounts. You can go for this 44 AD route, provided your turnover again is less than that of 3 crore. So 2 to 3 crore turnover persons also can opt for 44 AD if their total receipts as well as total payment is as per that 95% condition or criteria. So in that case, if you are having that option opted for this 44 AD, then there is a condition. There is a condition. If you are going for that 44 AD, you have to be opting for that 44 AD section for the next 5 years. 5 years. 5 years. In 1718 only this amendment was being made into impact. So if you are opting for this 44 AD, then for the next 5 years you have to go for this section 44 AD. And if you are opting out from this 44 AD, if you are declaring the profit lesser than that of 44 AD, you are opting out from that section. And section 44 AD subsection number 4 would be applicable. In that section 44 AD subsection number 4, if you are opting out without going for that 5-year completion criteria, then for the next 5 years after opting out, including this year, next 5 years, you would be required to maintain books of accounts, and your books should be audited by the accountant prescribed, and you would be made applicable under section 44 AB E. 44 AB E clause would be applicable, and you would be required to get audited by an accountant prescribed. So this is what section 44 AD4 prescribed, 44 AB E prescribed. So here in which we may see, so those persons who have opted for 44 AD but doesn't stick in for 5 years, then for the next 5 years they have to maintain books of accounts, and their books of accounts would be required to be audited by the accountant, and 44 AA maintenance of books of accounts also would be applicable for them. So this is what the final clause E clause is all about. So the fundamental distinction between this 44 AD with that of 44 ADA is 44 ADA is per year concept. Say in this year, if you are not declaring 50% of profit minimum of your receipt, then this year you would be required to go for this tax audit. But in case of 44 AD, if you are opting for the same, you have to stick for next 5 years. That option is not, or that condition is not there for 44 ADA. Even though you have opted out this year, next year, if you are going to declare 50% of the receipt to be your profit, there is no requirement to get it audited. But that option to swap between this presumptive and this tax audit is not there for this 44 AD. So that is a fundamental distinction between ADA with that of AD. Then all these things, a single chart I was mentioning. If your turnover is less than 1 crore for a business entity, then there is no requirement to do the audit. If it is in between 1 to 2 or 1 to 3 crores, then you would be having that option whether to go for 44 AD or to maintain books of accounts, then do that tax audit. And if you are going for 44 AD, then 44 AD would be overriding 44 AB. So even though your turnover is more than 1 crore, if you are opting for 44 AD, there would not be any requirement to do the tax audit. Then comes 1 to 10 crore category persons. That also I was mentioning. If your total receipts as well as expenses is 95% or more is via non-cash mode, then you would not be required to do that tax audit. Over and above 10 crore, there are no exemptions. Definitely, yes, you would be required to do your books of accounts audited. So these are all threshold limits for a business entity, not for a professional. Why? Because we know for professionals it is only 50 lakh the limit. 50 lakh the limit. That 95% criteria. The higher threshold limit for 10 crore for non-tax or non-audit of accounts shall be available only if 95% of or more of all business receipts, whether a taxable, exempted revenue, capital or non-cash mode, and 95% or more of all business payment, whether capital, revenue and deductible or non-deductible are in non-cash mode. So this is what that 95% criteria is. Here both revenue as well as capital, taxable as well as exempted has been included with. Now comes the interplay between this 44 AD, 44 ADA with that of this section 44 AB. Now on or before deciding whether the books of accounts have to be audited, you have to decide whether we are required to do our books audited by the accountant. So therein, definitely yes, this slide may be throwing some light, maybe guiding to decide whether the tax audit is applicable for us, whether we are required to go for presumptive options and all. Definitely yes. From this, some illustrations we would be getting an idea about. So I do request all the learning participants to have an kind attention to these illustrations that we are going to discuss with. So interplay between 44 AD, 44 ADA with that of 44 AB. First illustration, Mr. A, individual, started manufacturing. So he's a manufacturing assessee, first year. So prior to which he have not done any business. So definitely you may presume he have not filed income tax return also. Turnover, all cash, 150 lakhs, 1 crore 50 lakhs being the turnover. Net profit 8 lakh, total income 8.5 lakh. So these are all the particulars which has been given. So we know even though your turnover is less than 1 crore, if you are not having total income to be taxed less than basic exemption limit, then again there is a proviso wherein you need not get your books of accounts audited. So that point also you have to appreciate while discussing all these illustrations, but not so in this case. In this case, Mr. A have started the business, so no previous returns. Total receipts being 1.5 lakhs and everything is being in cash. So we know for non-cash it is 6% to be the presumptive income. For cash it is 8%. So 1.5 crores, 8%. Definitely yes, you would be required to declare 12 lakh to be as your net profit. But here in this case, you are declaring only 8 lakhs, 8 lakhs, 8 lakhs, which is lesser than that of that 8% criteria. So if you are not declaring minimum 8%, you cannot opt for 44 AD, we know. Then for the reason the total turnover is more than 1 crore, 44 AB A clause would be applicable, and thereby 44 AB audit you would be required to do. So first one is simple illustrative example. For the basic reason, your profit declared is lesser than that of 8%. 44 AD would not be applicable, but for the reason 44 AB A clause, your turnover is more than 1 crore, 44 AB section would be applicable. Second illustration, Miss B trading turnover all cash 90 lakh, net profit 10 lakh. She's also a doctor, having a fee 45 lakh, net profit 25 lakh, total income 32 lakh. So here, three sections would come into interplay. Section 44 AD is there. Section 44 ADA is there. Section 44 AB is also there. So which are all those sections which are going to be hit here? So we know here he is a trader. He is having turnover less than 1 crore, 90 lakhs. And they are declaring profit more than 8%. 90 lakhs, 8%. He is declaring more than that 8%, 10 lakh rupees they are declaring. So whether 44 AD is applicable is question number 1. Question number 2. She is also a doctor and the total receipts is less than 50 lakh. So 44 ABB would not be also applicable. 45 lakhs is the receipt and is declaring more than 50%. Because 45 lakhs, 50% would be 22.5 lakhs. They are declaring a profit from this profession for 25 lakh. So thereby they are declaring more than 50% also. So the question is question number 2, question being whether 44 ADA would be applicable in this instant case. Third question, whether there is a requirement of tax audit. Because if you see the total receipts, 90 lakh rupees plus 45 lakh, totaling to 1.35 crores. So if it is more than 1 crore, whether the books of accounts has to be audited is the next question. So whether 44 AB is applicable is question number 3. So these 3 questions we would be required to answer with this simple illustration. So if we go through those sections in deep, you would be seeing or you could be having this impression that section 44 AB, section 44 AD, if it is applicable, the answer is no. Some may be wondering why no, because they are having turnover less than 1 crore. Okay. They are declaring profit more than 8%, 10 lakh. Okay. Then why not 44 AD? Because under section 44 AD, there is a rider. The section itself restricts certain persons not to participate with this section 44 AD. Those persons who are having commission income, those persons who are having agency business, those persons who are having specified profession, specified profession we know, profession in area of medical, in the area of accountancy, legal, architect, interior decoration, film related area, company secretaries, etc. So those persons cannot participate for 44 AD. Despite the fact all the other conditions are being satisfied, if they are a specified professional, if they are a person having commission income, agency business income, then they cannot participate with 44 AD. For the same reason, here in this instant example also, my dear friends, even though they are declaring profit more than 8%, they cannot participate for 44 AD. Then second question being whether 44 ADA is applicable. Yes, because their total turnover is less than 50 lakhs and they are declaring profit more than 50%. So definitely yes, 44 ADA is applicable. There is no restriction in 44 ADA as if in case of 44 AD. In 44 AD, if you are a businessman having specified profession, you cannot opt for 44 AD, but similar clause is not there in 44 ADA. If you are a specified professional, if you are having business income, still you can go for what? 44 ADA. So similar sort of restriction which was in 44 AD is not here in 44 ADA. So therein, if you are declaring more than this 50%, then definitely yes, 44 ADA would be applicable. Now the third question that I asked, the answer being whether this 44 AB would be applicable. The answer is no. Why not? Whether their turnover is more than 1 crore, the answer is business turnover should be more than 1 crore. 44 ABA, business turnover should be more than 1 crore. Here in this instant example, definitely yes, business turnover is only 90 lakhs. If you include professional receipts also, then only your turnover would be more than 1 crore. Here, for the time being, for the reason that business receipts alone is lesser than 1 crore rupees, definitely yes, 44 ABA is not applicable. Similar in case, if only the professional receipts is more than 50 lakhs, 44 AB B clause would be applicable. Here the professional receipts is only 45 lakhs. You cannot or you are not required to include this business turnover also along with this professional turnover. Thereby, the clause A as well as B is not applicable. Now the next principles, that is, if they are declaring less than 50%, if they are declaring less than 8%, that point is also not relevant here for the basic reason they are declaring it more than 8%, they are declaring it more than 50%, respectively the business receipts as well as the professional receipts. 44 A, B, D and E clauses also would not be applicable. So this is why the reason 44 AB is not applicable for this instant example. Second illustration. Definitely, yes, if you are having any doubts, you may please text. At the end, we would be discussing all these questions. We would be having the time at the end of this session. Now comes the third illustration. See, first year, trading turnover. All receipts are in cash. 80 lakh, the total turnover. It's a trader. Net profit they are declaring is 4 lakh. Total income is 3 lakh. So two questions here. Whether 44 AD is applicable or 44 AB is applicable or any other provisions are applicable. You may see. So at the first impression, we may be having that notion. Here, they are not declaring profit 8%. Why? Because the total receipts being in cash form. So you would be required to declare 8%. 8% would be required to be declared under 44 AD. So definitely we know 80%, 80 lakhs, 8%, 6.4 lakh you would be required to declare. Here the net profit is 4 lakh only. Then whether 44 AD is applicable? No, it is not. Why? Because you are not declaring profit at 8% of the receipts. Now comes whether 44 ABE clause is applicable. Relevant question, because you are not declaring profit 8% presumptive. So whether 44 ABE would be applicable. I was mentioning 44 ABE being the clause wherein 44 AD opted out cases are being tax audited with. So if you see, it's quite evident from the question itself. It is their first year. So definitely, yes, you have to presume the previous years they have not filed the income, even though they have filed, they are not having any business income. So in the previous years or any of the prior periods, they have not opted for 44 AD. So I was mentioning only if you have opted for 44 AD, then only you have to keep intact with this 44 AD for the next 5 years. If you have not opted for 44 AD at all, if your turnover is less than 1 crore, you simply require to maintain books of accounts under 44 AA and you can report the income as per your books of accounts. Even though such amount is lesser than that of prescribed 8% or 6%, you need not get your books of accounts audited by an accountant. Rather, you can simply upload your profit and loss account and balance sheet and you can file your ITR 3. Tax audit would not be applicable. So there is no condition that if your income is lesser than 44 AD, you have to do 44 AD. Only if you have opted for 44 AD in any one of your previous periods and you are opting out via section 44 AD for subsection, then for the next 5 years, you would be required to audit your books of accounts. But this being the first year, then you need not. May it be second year, last year also you uploaded P&L account balance sheet, your turnover is less than 1 crore. This year also your turnover is less than 1 crore. You are not declaring profit 8% or more, 6% or more, no issues. You upload your P&L account, you upload your balance sheet, there is no requirement to get the books of accounts audited under section 44AB. So yes, so 44AD not applicable for the basic reason you are not declaring profit at 8% or more. 44AB is not also applicable for the basic reason I was mentioning. It is the first year, so you have to presume they haven't declared any profit in that 44AD. So they have not opted out. 44AD 4 clause is not applicable. Thereby, this 44ABE would not also be made applicable. Then the relevance of total income 3 lakh. So I was mentioning, even though you have opted for 44AD in the previous year, supposing in this year your turnover is less than 1 crore, you are not declaring 8%. Definitely, as you had opted out, you have to get your books of accounts audited. Again, an exemption. If your income is lesser than that of that taxable limit, then you need not get your books of accounts audited. That point also you have to keep in mind. So on to our final illustration. Here you may see Mr. T, a trader, turnover all cash 95 lakh, 5% 6 lakh to be the commission, net profit 15 lakh, total income 14 lakh. So here in this case, they are declaring profit more than that of this turnover, business receipt 95 lakh more they are declaring. 95 lakhs, 8% or more, 15 lakh they are declaring it to be as a profit. But the thing is, I was mentioning for ineligibility conditions for those 44AD opters, the first and foremost one being if they are having commission income, if they are doing agency business, they cannot go for this 44AB option. So definitely yes, here in this instant example, Mr. D, they are having commission income, thereby they cannot go for this 44AD. So 44AD is not applicable. Now the next question is whether this 44AB would be applicable. You may see yes. Why yes? Why? Because this 95 lakh is their trading receipts. Along with that trading receipts, they are having commission income. That commission income is also subject to be turnover, business income only, business turnover only. So their aggregate turnover would be 95 lakh plus 6 lakh. 1 crore, 1 lakh would be the total receipts, turnover, sales, whatever you call. So in that case, definitely yes, you are having the receipts more than 1 crore, then this section 44AB clause A would be applicable. Thereby, you would be required to do your books of accounts audited under this section. These are all various permutation combinations. Lot and other examples are there. Due to paucity of time, definitely yes, kindly to have an impression over various applicability of these sections. And only if all these eligibilities are there, then only you do that tax audit. Without that tax audit being applicable, if you are doing the same, that also would prove to be costly. Definitely yes, because the due dates and all would be different. If you was under that non-tax audit category, you may have or you should have to file the return on or before 31st of July. You didn't read it. Now that relevance, you may see while opting that new regime and all, you have to do that 10EA, whatever form it is, on or before 139 one-time limit. So in an impression, if you are a non-tax tax audit assessee, if you have not filed it and you have filed tax audit and along with that new regime after 10 IEA on or before 31st of October, that you may be losing to claim that newer regime benefits because you are supposed to file that form on or before 31st of July. Similar in case of carry forward of losses also. Losses can be carried forward only if you have filed the time limit within the time limit you have filed your income. And if there is misimpression, if you are filing the same on or before this 44 AB time limit 31st of October, then you would be losing that opportunity to carry forward the loss. Even though the time limit for non-tax audit cases already over, 31st of July already over. Again, this point can be kept in mind. So only those files which are required to be audited, you have to do. Otherwise, no requirement to do the tax audit process. Then slowly we are moving on to various clauses in this tax audit. So almost half of our term done, 45 minutes over. The next phase, we would be discussing some of those all those 44 clauses, definitely yes, we cannot discuss within this time limits. But some of those which I felt to be discussed right now, we have picked, and all those clauses we would be discussing. So I was mentioning this total audit report is having two forms, 3CA, 3CD, or maybe 3CB, 3CD. May it be 3CA or 3CB, it's the audit report that the auditor is going to upload. This 3CD is supposed to be prepared by the assessee. Even though it is been practically prepared by the auditors only. Here, the 3CD is supposed to have been prepared by the assessee, and that has to be uploaded by the auditor along with their audit report. They have to approve that form. That's it. So in that context, what are all those clauses in that 3CD? Quite relevant. Why? Because in those clauses only, all those discrepancies, all those variations, all those points have to be mentioned, quantified in numerics and all have to be done in this many clauses. So that form 3CD also has been subclassified into two parts, part A along with part B. So part A, numbering from point number 1 to point number 8A, and from that 8A, it moves on to clauses 44. 44 clauses are there. So this is in total form 3CD, out of which clause 8. Clause 8. So basically things, the name of assessee, PAN, address, the places where books of accounts are being maintained, all those things, basic points are there in part A, and in part B, some other points. In 8 also would be forming part of part A. Therein, which clause you are doing that tax audit. That point is also quite relevant. That point is also quite relevant for the basic reason I was mentioning earlier also. If it is been done under 44 AB, A, B, E, D, wherever it is, that has to be specifically mentioned here. Wrong selection of these sections would prove to be a costly error. So for that sake only, I have selected this clause number 8, nothing more. Then comes clause 8A. Clause 8A. So what is the relevance of this clause 8A? Recently, if you see this 3CD, you may see various amendments are there for this clause number 8A. So what is this clause 8A is all about? So I was mentioning totally 44 clauses are there. Inserted clauses are also there in between. In number it may vary, but in serially it is up to 44 only. So among the same 8A. 8A requires to be reported what type of tax regime the assessee have opted for. So the first and foremost practical infeasibility here is the last date for uploading the tax audit report is on 30th of September, and another 1 month is left for those assessees. They can either opt for old regime or they can go for new regime. So if they are going to go for, if they are going to opt out from their new regime to their old regime, then they would be required to file the 10IEA form and all. And as an auditor, we cannot know at the time of filing your respective audit report whether they are going to go for this new or old regime. But anyhow, definitely yes, we may be knowing our clients, we may be knowing the assessees. In that context, what is their plan? How they are going to go for their income tax rate regime selection? We need to get a note about. In that case, that sort of thing you may do here. So we know in this assessment year 24-25, this many types of new regime taxations are there. 115 BA is there, BAA is there, BAB is there for companies who are having those prescribed conditions less than 400 crore the turnover. Then 22% taxation, 15% taxation if they are waiving of various exemptions, deductions, etc. Not claiming those additional depreciations and all. Then manufacturing startups and all, they would be getting that 15% prescribed rates. Then 115 BAC 1A, we know other than companies, individuals, other than partnerships, individuals, AOP, BOI and all, you can go for this 115 BAC 1A option, wherein you are going for that new tax regime rates without deductions, without exemptions. You are getting lower rate of taxes. And if you are opting out, you can go for that old regime. Similarly, in case of cooperative societies, 115 BAD is there, rated being 22%. And for new manufacturing cooperative societies recently inserted, 115 BAE is also there. So this many presumptive sections are there. So now we know, except for partnership firms, all other types of persons do enjoy that two options, either to go for the old regime or to go for this new sort of regimes respectively. So that how the assessee is going to go for this regime, this thing, you would be required to report in that form 3CT. Then comes clause number 12. What is the relevance about this clause number 12? If you see, the assessee can have a part of their business or income to be audited by an auditor under 44 AB, and some other parts they can opt for presumptive options. Whether it is possible? Yes, it is. Supposing myself to be a practicing professional, a specified professional, supposing I am to be a medical practitioner, and I am having some other trading income also. And if my trading income is more than say 10 crore rupees, if my business receipts which is more than 1 crore, then I would be required to get audited under section 44 AB, A clause. But in case where if I am having that business, what do you call it, professional receipts, supposing that to be 40 lakhs, then I can go for 40 for ADA for that 40 lakhs and 20 lakhs I can very well declare. So in such cases, there can be some practical scenarios wherein in the profitability statement, in the profit and loss account, both accounts, why? Because the consolidated returns only, the income tax returns only, the individual is submitting. So in their respective profit and loss account, there would be the income with respect to business as well as income with respect to this presumptive profession. In such cases, if they are having some other presumptive cases, that also would be required to be reported in this clause number 12. But there, the authenticity or that accuracy or that audit of such presumptively declared income need not be done by the auditor. That's what this clause number 12 is all about. Then clause number 16, amounts to not credited to profit and loss account. So therein, amounts not credited to profit and loss account, meaning there can be certain income which are not being taxable, which was not being made taxable while crediting to profit and loss account. We know all those incomes we would be required to add while computing the income tax returns. We know the net profit as per P&L account, add inadmissible expenses debited to P&L account, add taxable income not credited to P&L account, less admissible expenses not debited, less non-taxable income credited to P&L account. So those adjustments to calculate that profits and gains from business and profession, we know. So in this context, if any income not credited to P&L account, may it be section 28. Section 28 prescribes which are all those incomes which would be held to be taxable under this head PGBP. So in that context, if any such income are not being credited to P&L account. Especially we know that section 194R. Now in that context, section 194R speaking about those perquisite or benefit arising out of this business activity, maybe in kind or maybe in cash received, 194R would be applicable. So definitely as in 26 years or AAS, if any section 194R is being applicable, if it is in non-cash mode, in accounting, we know that need not get been reflected. So if such income is not being credited to their respective P&L account, then we have to be vigilant. Such income we would be required to add here. Such sort of any income which was not being credited to P&L account, but which is an taxable income, Definitely yes, that has to be reported here, and if it is been reported, the income tax department is also vigilant. Risk management strategy of income tax department would be picking the assessee, and other applications would be also there. So in such cases wherein such incomes are not being credited, have to be reported by the auditor here. Crucial clause number 20. What is this clause all about? This clause asks the auditor to report various points with regarding to employee benefit. So therein, we would be required to give the figures of sum paid to employee as bonus or commission, where the same was payable as profit or dividend. So therein, if there is any appropriation of profit, we know appropriation of profit is an inadmissible expenses. That appropriation of profit you cannot deduct. So in case wherein some salary or something has been given away as appropriation of profit, then it would be an inadmissible expenses that has to be declared in clause number A. Over and above, clause number B, quite crucial. Why? Because if you have received any contributions from employee in form of provident fund employee contribution, superannuation employee contribution, etc., and that amount received from the employees has not been deposited to their prescribed funds, maybe PF fund, maybe ESI contributions. So those things you have not contributed within the due date specified under that act, Gratuity Act, PF Act. Suppose next month the 5th is the last day to make the payment. You have collected that provident fund from your employees, but you have not deposited in on or before 5th of next month. Then the replication is the amount collected from such employees as employee provident fund contribution shall be the income, and such payment made to such prescribed fund only would be treated to be as an expense. So what does it mean? If you have collected employee contribution, that's your income. When only you are paying it on or before those prescribed dates, then only you can have it always a deduction and both would get netted off. Then received contribution, paid contribution would not be treated as your income at all. But in case wherein you have collected, but you have not paid in on or before the prescribed due date under relevant act, then the income would be income. You cannot get that payment made to be as an expenses. So quite crucial. If we are having that EPF registration, ESA registration, whatever employee funds that we are contributing, any amount if you are collecting from your employee, that amount have to be paid within the due date as per the prescribed tax, what do you call it, prescribed laws, prescribed labor law acts. Otherwise, such income collected by virtue of that income, it would be taxed to be as an income. But for the reason you are not paying it within such due date, it would not be treated as an expense. So income only would be getting taxed, expenses you would not be getting, even though you are paying it after such due dates. So such sorts of instances have to be avoided. Otherwise, in the tax audit report, the column is there wherein all these things would be reported by. Then if you have not shown that to be as an income, then income tax notice would come. So what are all those nature of funds? Some received from employees. It's employees contribution, my dear learned participants. It is not employers contribution. Employers contributions towards all these funds definitely is 43B only talks about all these things, and you would be having that time limit up to 139 one time limit you are having. But for employee contribution only, you would be required to make the payment paid before the respective laws, respective labor laws, not income tax time limits. So actual amount paid, due date for payment, actual date to be paid to the concerned authorities, you would be required to, or the auditor would be reporting. Then various disallowances I am not touching on, 40A, 41A, cash payments 40A3, and all we would be required to report. Then comes, this is quite crucial point. Lot of discussions, lot of dilemmas, a draconian provision per se, which was been inserted with Finance Act 2023, wherein we know 43B have been included with a clause H, 43BH. So section 43BH if you have received any goods or services from a micro, small enterprise registered under MSME Act 2006, if there is no agreement persisting between yourself with that of MS unit, then you would be required to make the payment within 15 days. And if you are having the agreement with that micro or small enterprise, you would be required to make the payment within 45 days, or with less than those agreed limits, you would be required to make the payment. So if you are not made the payment within 15 days, or you have not made the payment within 45 days, then the entire sort of amount outstanding as on 31st of March 2024 for this relevant year would be treated to be as inadmissible. And only in the year in which you are going to make the payment to such entities, then in that year only it would be treated to be as an admissible expenses. So this is what this section 43BH is. So now from this year only, this section is applicable. So before general elections and all, there were some rumors that this section would be omitted. It would not be made applicable and all. But now there is no mentioning of this 43BH in the recently concluded budget. No circulars, no clarifications have been came in order to repeal those provisions. So for the time being, we have to presume this 43BH section is applicable for those financial year 23-24 read along with assessment year 24-25. So if there are any outstandings as on 31st of March 2024, 15 days, 45 days expired, and if it is micro, small, registered entities, that also another rider is there. Discussions are there wherein this clause is applicable only if you are a micro and small manufacturer or a service provider. So if they are a trader, then such traders, this extra benefit would not be eligible. Various discussions are there, expert opinions are there. So even though if you exclude the trader sort of supplier, if he is a manufacturing or a service providing supplier, then any outstanding more than 15 days or 45 days, and it is as on 31st of March 2024, then the auditor would be segregating those records and all those payables this year. If they is reporting in this clause number 22, it is going to get inadmitted. In other words, it would be a taxable income. So that draconian provision. So earlier it was being made in order to facilitate the payments to be received by micro and small enterprises, in order to enhance their liquidity position, in order to have their better working capital. This principle or this idea of amendment was being made, but literally what is happening is, in practical sense, nobody is right now willing to participate with micro and small dealers. So they are actually lagging now. So anyhow, that provision is there. This is what that section is. It is applicable till now. And for the time being, if there are any outstandings as on that 31st of March 2024 from micro and small registered enterprise traders, you can exclude manufacturers as well as service providers. Those things would be reported in this portion, clause number 22. Apart from this disallowability, provision for interest is also there. Which is over and above the normal bank rate. So that interest also would be required to be paid for such delayed payments. So those things also would be required to be mentioned in this clause number 22. So we know the total things outstanding as on 31st of March 2024. So if some amounts were being and it may have been there for delay of 15 or 45 days, but that was being paid on or before 31st of March, then these disallowances would not be there. But in case wherein it is still pending on 31st of March, this issue would pop up. But if you have paid that too before 31st of March, even though it is not outstanding, for that lag for not making payment within 15 days or 45 days, the interest liability would be there. Plus manufacturing or service provider only this would be applicable. I was mentioning for traders, it is not applicable. Yes. Then comes section 41 applicability. Clause number 25, if there are any deemed income, any of those assets which was been used for research and development purposes, the entire deduction has been claimed. Now it is been sold, discarded. The entire value is deemed to be an income. Then any doubtful debts, return of any remission of liability, everything would be deemed income. So all those things which are to be treated to be as a deemed income also would be reported here. Why I am focusing on these sections are if anything has been done here, RMS, risk management strategy of income tax department would be triggered and very chance that that would be taken for scrutinies. Then section other than this 43B, a lot of other expenses which has to be made, the payment which has to be made on or before 31 one time limit is also there. So what is the challenge here? The point I was mentioning, the audit report have to be submitted on or before 30th of September. The 139 time limit or the time limit within which the return can be submitted is up to 31st of October. So after suppose example one loan interest is there payable to a scheduled bank or a nationalized bank. As per these 43B provisions, you have to make the payment on or before 139 one time limit. Then only such expenses can be treated to be as an admissible expenses. So what would happen? Here the assessee, the payer is having the time limit up to 31st of October, but the audit report have to be submitted on or before 30th of September. So suppose they have not made that payment on or before 30th of September, but they are making the payment after 30th of September before 31st of October. So in that case, the auditor would be reporting that to be under 43B. Why? Because till that date of submitting that audit report, they haven't made the payment. But as I see, the taxpayer do have that option to make the payment before 31st of October, and they had made that payment also. So in that case, this dilemma would come. Now there is an option wherein even though the auditor have disallowed or have shown such amount in 43B, they have made the payment before the submission of return or 139 one time limit. They have made the payment. Then it is not disallowable at all. In such cases, now the income tax department provides the facility to revise the audit report submitted. So those expenses which was not being paid till the submission of audit report disallowed but paid within that time limit, the auditor can revise the return after payment and after submission of that return. So those things also you would be required to taken care of. So those things which were not being paid till submission of audit report, you have to report. Then it is being made within that 139 one time limit, you have to revise the report. Discrepancies are not there, disallowances are not there. Such way you would be required to report with. So that point also I want to make a note on. 43BH, 43B other sections. I'm not going on to close by close analysis. Then quite important 269 SS, 269T, 269 ST sections, 3 draconian sections. Cash loans should not be more than 20,000. Loan repayment should not be more than 20,000. No cash transaction should be there in section 269 ST more than 2 lakhs. If it is so, similar amount of amounts shall be the penalty. So all those things which has been happened there, the auditor would be reporting. So all these things definitely yes would have to be taken care about. So those things should not be there. Now we know for those companies and all audit trial options are also there right from this year 23-24. So definitely yes, you cannot edit. You cannot split all those transactions. Why? Because all those splitting and all would be captured in that edit log window. So every chance that auditor can find all those additions, deletions and all. So better not to make such cash loans, cash repayments for loans as well as 269 ST transactions. So this is what about this basic cash restricting transaction sections are 269 AAS, T as well as ST. TCS and all, if it is been made within the due date, if there is any delay, all those things you would be required to mention here. Then comes clause number 35. This section, clause number 35, definitely yes, do have got direct effect to that of 142(2)(a), cost auditors appointment at the time of scrutiny. We know that section 142(2)(a), stock valuation, inventory valuation to be assigned to a cost accountant. by income tax authorities. So if we are being cost accountants are being devoted with these assignments, the clause that we would be required to see is this clause number 35, the quantitative details of those stock, of those raw materials, of those finished goods, of those work in progress and all. So if you come across any discrepancies with that of actuals at the time of physical verification, at the time of costing, inventory valuation, with that of those things which are being reflecting in 3CD, specific column in form 6C is there, reporting format is there, wherein you would be required to report and all. So quite due diligently, we would be required to reconcile those figures which has been mentioned in this clause number 35 with that of those things which have to be reported in form 6C. So as a C perspective, auditor perspective also, these things at the time of uploading have to be done viciously, otherwise definitely as it would prove to be costly. Clause number 35. Basic accounting ratios. Then comes clause number 44, last clause, quite a relevant clause. So in this clause number 44, definitely yes. We know 9C GST is not there for the last 2 years. Here the issue being the audit report are not being submitted by cost accountant or a chartered accountant right now. So no independent audit is there for GST. But sooner it has been excluded from GST audit perspective. This clause 44 was been inserted in this 3CD format, wherein the GST related details have to be segregated and have to be done in this clause number 44. Even though you cannot compare this clause 44 with that of 9C compliances, but many of those provisions, directly or indirectly, are being included here in this clause 44 also. So here, while preparing the accounts, this clause 44 also would be required to be kept in mind. Why? Because this 44 requires various numerics, various accounting data that is required to be reported. So what are the data that is going to get reported in this column 44? Serial number you have to, total expenditure you have to, out of that total expenditure, the expenditure relating to goods or services exempt from GST. There may be certain purchases, say vegetables, nil rated goods, or any other sort of non-GSTable things. If you had done all those things, definitely yes, you would be required to give it in that exempted column. Then if you have received any of those goods, services, capital goods, etc. from composition levy dealers, section 10 dealers, then that has to be given in this third column. Then comes if we had purchased such goods, availed services or capital goods from registered entities, that would be required to be done in the next column. And finally, if it is not an exempted goods, if it is not from composition dealer, if it is not from a registered dealer, then if you had purchased some taxable supplies from unregistered dealers, those things you would be required to give it in this last column, expenditure in respect of entities not registered under GST. So if you are giving more figures in that column, there is a very good chance that your file may be reported under RMS. Those expenses may be required to get re-verified. So scrutiny assessments, everything may come into be force. So better to have purchased from those registered persons, composition persons, etc. Otherwise, there can be a doubt in departmental sort of procedure wherein whether these expenses are bogus or not. So in that context, in order to catch those bogus transactions, they have made this clause 44 applicable for the last 3 years. So this is what about this clause number 44. So question would be, what are all the things which has to be reported there? Both the capital as well as revenue expenditures have to be reported. Whether provisions has to be done, no, it is not an expenditure. So whether depreciation has to be done, no, depreciation is not an expenses. Employee expenses also out of purview of GST, not to be done here. So likewise, exemptions are also there. But all those things other than these exemptions, you have to bifurcate, either it to be from in form of exempted one, either to be in form of this composition one, registered entities, unregistered entities also you would be required to do. More and more the percentage is from unregistered one. There can be chances that our file can be selected for scrutiny. Now, some auditors do have got a practice to give a disclaimer or not to give an opinion. For the reason they are not maintaining books of accounts in order to get this many data. But personally, it is not preferable. Why? Because we are ourselves declaring that we are not having those books of accounts as prescribed under 35, 36, whatever it is, under GST Act. 56 rule you are not following under CGST rules. So in that context, better to keep the books of accounts in such a way that we are getting these figures. And now after this ERP software and all, definitely yes, we would be getting those details from our softwares. So better to go for this reporting under clause 44. So this is the last clause that I want to discuss. So with this, the PPT from my part is over. And the last 10 minutes or what, definitely yes, we would be going through the questions which are being popping up in my chat box. So for the last 1 hour, 20 minutes, we were having a brief introduction, not actually an in-depth analysis, only an applicability sort of a thing, interplay between those presumptive sections with that of tax audit things. Some of those key amendments, key sections which are been applicable for the relevant reporting and all we were discussing. Any doubts, any clarifications? Definitely, yes, you may feel free to text. So I do think TRD department, we can go to those questions which are appearing in the chat box. Can I? Yes, first question, all are anonymous participants. While calculating gross receipts of professionals, what documents are required or permitted to support those receipts? Definitely, yes, they are receipt voucher. Why? Because under Rule 6F, the prescribed sorts of receipt vouchers they would be required to have. If you are a medical practitioner, patient register also you would be required to keep with. So on that basis, we would be required to calculate that gross turnover. Then whether CMAs are eligible to do tax audit now? For the time being, no. Only 288A accountants, being chartered accountant, is also only eligible to do that tax audit exercise. For the time being, CMAs are not eligible. Then B. Kumar from Chennai. If the assessee is having turnover in trading, manufacturing, a professional wherein the threshold limit are within the limit, but he is an author of books and his total income is more than minimum taxable limit, what would be the position in case of 44? 44, which clause actually I couldn't get. I do presume it is 44 AB. Assessee is having turnover in trading, manufacturing, and professional, where threshold limit are within the limits, but he is an author of books and his total income is more than basic limits. Even though their turnover is more than basic limits, I was mentioning B. Kumar sir. The point being, your turnover for business is more than or less than 1 crore. 44 AB, A clause is not applicable. But the point is, you have not opted for this section 44 AD in the previous years, then you are not required to go for a tax audit. First thing. The next thing, if your total receipts is less than 50 lakhs, if you are declaring 44 ADA, 50% of your professional turnover, then also tax audit is not applicable. If you are an author, there is no requirement that your books to be audited with, provided your total business turnover is not more than 1 crore, your professional receipts is not more than 50 lakh, and the remaining non-compliance with presumptive taxation options are not being opted, you can definitely not required to get your books of accounts audited. Hope you are clear. Then comes whether transactions of rupees 20,000 are to be reported. If it is only more than, no person can receive 20,000. The 20,000 is also included. So no outstanding amount of loan, no repayment of loan should be 20,000. Then all those transactions has to be reported under 269 SS and T. And the entire amount of loan and repayment would be required to be the penalty required to be paid to be as a penalty. So when it is been reported in that clause, definitely yes, those penalty would be appearing there. So 20,000 is also applicable. Clause 35 is different in this scenario. The value of stock is certified by CA only. And as the officer has any doubt, then only he would assign the inventory valuation. Yes, definitely yes. The point that I want to mention there was, in case wherein we are doing that inventory valuation, the quantitative report that we can check with is this clause number 35 reported in this tax audit report. So that is not done by the CA. It is been certified by CA, as you rightly mentioned. But definitely yes, if they are having any discrepancies with that of those things, with that of the actually found one, then the assessee also, as well as that reporting accountant also would be responsible to make a reconciliation about. So there would be a cross verification. That only the point that I want to mention. For clause 44, whether the total expenditure to be reconciled with reporting period. Yes, it is. That has to be done with, because no other excludable item. Only expenditures have to be bifurcated here. Provisions, depreciations and all I was mentioning not to be included. Apart from those things, any expenditure appearing in P&L account, you have to put it in this clause 44. If there is a big gap between 44 and this thing, so you have to presume it is from unregistered persons only. So you have to reconcile it, and almost all those things which are appearing in P&L account debit side, you have to report in this clause number 44. Bala sir, already I mentioned that question. Karthik Gabari sir, please clarify under GST declaration clause effect of any discrepancies in turnover, exempted goods turnover by the client side. So definitely yes, that everything would count, because now there is an interchange information between income tax department with us GST and all. So in such cases, there should not be any discrepancies with that of those things which are being reported in your GST sites with that of those things which are appearing in clause 44. So there should not be anything. In case if there are any of such discrepancies, definitely yes, you can rectify those things in GST if any, while submitting GSTR 9C, wherever it is. At what purpose we do tax audit? Tax audit, for the basic reason, the department cannot go for scrutiny assessment for all those business assessees. So they want to comply with all those provisions. They want an independent audit. So in order to curtail those tax evasion practices and in order to comply with all these things, the department have designed this tax audit, and that being the basic purpose. If company in its first year of operation, then is there any special consideration? No, it is not, sir. Not for a company I was mentioning. For 44 AD clause only I was mentioning. If they have not opted for 44 AD previous year, then even though they are not declaring profit at 8%, if their turnover is less than 1 crore, they need not go for 44 AB I was mentioning. So there are no special consideration except for that 44 AD for 44 ABE applicability I was mentioning. Whether GST duties are included in turnover? No. Any specified details to be considered? No turnover. Question is not clear, Meenambigai madam. Any standard format for clause 22 MSME? In that report, standard format is there. But in order to get the declarations and all from those MSME units, no prescribed formats are there. If we have received 10,000 in previous year and 11,000 in current year, then whether it is a reportable transaction as 21,000. Question is not clear. Punit Sharma sir. I do presume that to be a loan. So if it is to be a loan or to be under 40A3, I don't know. Loan I do prefer. So if you have received any loan 269 SS, So if the total outstanding amount of loan from a single person, if it is more than 20,000 in cash, then definitely yes, this section would be applicable. I do presume that to be allowed. So that's all the questions. What about? And time limit also over for 30 sharp. Any more questions? Definitely yes, you may type in the chat box. Otherwise, over to you, TRD. Mukulika madam, Priyanka madam, are you there? No turnover as of March 24. Company was just incorporated.
Thank you, sir.
Yes, madam. Last
Thank you,
question
sir,
I'm
for your
addressing.
time.
Yes, madam. Last question I'm addressing, madam. 1 minute, please. One more question. Can I?
Thank you so much, sir, for your time.
Okay. I do think time limit is over. We shall address this later. Thank you all for your patient listening. Thank you, TRD, allowing me this opportunity. Thank you all again for your patient listening. Thank you once again.